Good afternoon, everybody. First of all, I'd like to introduce you the panelists of today. On my extreme left side, you have Bellemans. He's a professor at the Vesalius College in Brussels. Bellemans, I repeat, is adjunct professor at the Vesalius College in Brussels. You know already Paul Jorion. Roelandt, here on my left side, it's been 19 years, I think, chairman of the Dexia Insurance, or now Belfius Insurance, but now he's owner of his own consultancy office. On my right side, Thierry Philipponnat. He worked the past 25 years in the financial industry, I think UBS, BNB-ULB, among others, yes. And in the NGO world, now he's Secretary General in the Finance Watch. That's an NGO founded in 2011, which deals with financial markets and their regulation. And on my extreme right side, Mathias Dewatripont, Director of the Nationale Bank, Belgium. Do you hear me better now?
I think it's still working.
Yeah, okay, let's see. So, we talk about the financial world and its regulators. So, Mr. Roelandt, I have a question for you. What is the exact role of the regulator or supervisor?
Well, that's a very difficult question, and I think if you look at the different regulators or in the different markets, they all will have their specific definition. When you look, we created in Belgium recently, let's say, a new regulator, which is the National Bank, who took over some of the responsibilities, and the law who is creating that talks about in Dutch about toezicht. Yeah? It's not, if you use the English word regulation, it's a bit wider than toezicht, supervision. Yeah? And so that's the entire question. What is the role? What's the role of the supervisor? Is it only to supervise, toekijken, which is rather passive, or is it a more active role? Is it also to create regulation or to stimulate the industry? I'm a liberal thinker there. I'm moving more to the creation side of things, but then that's not what our Belgian law is telling us. So if our regulator are more on that side, they are doing, let's say, something maybe out of their scope. Maybe it's a good question for our regulator to answer that one. What do you think?
Well, I think in general, in these kinds of topics, we indeed distinguish regulation and supervision. And for example, today when we talk about the banking union, we are talking about a single supervisory mechanism. The supervisor is meant to implement, I wouldn't go passive, to implement the regulation. Now things are not black and white, in the sense that in Belgium, for example, the role of the supervisor, which now is for banking and insurance, the National Bank, is also to produce a number of circulars which are details of the regulation. The idea being that in a democracy, the biggest pieces of regulation are decided by Parliament. And then you delegate a number of details, possibly to the supervisor. And so in general, the supervisor also fills in the details of the regulation. Now then, the question is how passive one can go, and indeed one can be more or less dynamic as a supervisor in trying to do the implementation, and then the devil will be the details.
Okay. I give an example. In the past there was a split between savings bank and investment bank, but afterwards it disappeared. And we thought there was enough self-regulation in the financial markets, but it was not. Is this an example of the financial industry that tried to capture the regulators, Mr. Philipponnat?
Well, I think as could be expected, there's always that balance to find between private interest and public interest. And by definition, a private actor is going to be looking after its own interest, which is a private interest, and there's no surprise there. And in the case of banks, it is particularly important because banks are powerful institutions. They have a special power. They create money. I mean, it's not nothing. When they extend a loan, they create money, and therefore, that gives them a lot of power. And as everybody on this planet, they want to get bigger and richer. And on the other hand, you have something called public interest, and you have to find the right balance. And clearly, in the case of the separation or not separation of commercial banking from investment banking, this is a clear case where you have private interest who say, hey, I can make more money, get bigger, be more powerful. And you have public interest, which has a number of arguments. And then the debate starts. So yes, it is a clear case. And as Paul Jorion said in his previous speech, I mean, the way the Glass-Steagall Act, which was about separating banks in the US, was repealed, was a classical example of how private interests get into a position of power within the public sphere, and then make a decision that will, go in their favor. But at the end of the day, we should not even be surprised that there is an attempt to do that, but we should have institutions, systems that make sure that that doesn't happen, or should I say that the balance between public interest and private interest is kept relatively equal or fair.
Okay. There was also another principle, home country control, also by politics, but also by the banks. Maybe it was easier that way to capture the regulation, the regulators. And so they had protection of the home country if they were in trouble. Is this another good example?
I mean, there's many ways by which the private institutions, in what we're discussing with the bank, can capture or try to capture a regulator. And one of those ways is proximity and intellectual capture, which are not exactly the same thing. And it is obvious that the more distant you are, the less captured you can be. Now, there's also another dimension: is the closer you are, the better you know the entity you're supervising. Mr. Dewatripont is a much better place than me to speak about that, and therefore you're better able to do your job. But at the same time, I'm absolutely convinced that regulators are very well aware of it. The more you run the risk of being captured. Very quick example: in the US, you have a very efficient resolution authority called the FDIC, Federal Deposit Insurance Corporation. There's about 90 banks defaulting per annum in the US. Okay, 90. Okay, without any systemic crisis, and it goes down very well. And there's 2 or 3 lessons to be drawn from that. FDIC, first of all, is a very distant organization, as in, they're not friends of the banks. They're based in Washington, and when they, arrive in the morning in Kansas City because the Kansas City bank has gone, is in trouble, there's no, I'm not your friend. I'm just doing my job, and I can resolve the bank without having, the American taxpayer, paying for it. Another lesson is that, the average size of the banks they resolve is about $20–25 billion of total balance sheet, which, to put things in perspective, is probably is about 1% the size of the biggest EU bank. So, you're talking about much smaller banks. And the one time they tried to resolve bigger banks, Washington Mutual in 2008, was $300 billion, and they lost money on that, so the taxpayer had to pay for it. But that's another discussion. But being distant is clearly something that helps. Supervised bank, in my opinion. But I think
Yeah.
Neighbor would be better placed than me to speak about real experience of this.
But I think we have to be careful because I think this argument, by the way, is put forward very much today in Europe with this move to the banking union. So people like say, look, what a disaster the Spanish banking crisis has been. By the way, the Spanish banking crisis is interesting also because it has nothing to do with the 2008 crisis, which was very much complex product crisis, trading book crisis and all this. The Spanish crisis is about, so it's not at all about investment banks or anything, it's about little savings banks, the cajas, that have gone through the usual housing bubble, and whereby a number of local interests, political interests and all this, have meant that indeed even though the risks were well understood by the regulator, the supervisor, the Bank of Spain, they could not intervene because there was too much local political pressure in particular. And so indeed people are saying, it would be so nice if instead everything was decided in Frankfurt at the European Central Bank, and there, with distance, everything will be solved. I think we have to be careful with that, because, for example, you mentioned the FDIC, such a great success. It's true that the FDIC has done well. In the US, many things have gone wrong in the 2008 crisis, and Jorion has explained a number of things. For example, consumer protection was completely lacking, investment bank supervision was completely lacking, and so on and so forth. The FDIC did reasonably well, and indeed commercial banks in the US, with the exception probably of Citigroup, but Citigroup managed to get around it because it was a holding company thanks to the breakup of Castillo. It has gone reasonably well, but it has gone reasonably well because they had another crisis before, in the 1980s, called the savings and loan crisis. And there, everything was very much like the Spanish banking crisis, except that they had an FDIC. It was called the FSLIC, the Federal Savings and Loan Insurance Corporation. It was also federal, and it didn't work because basically it didn't have money, and the federal government didn't want to give them money. During the presidency of Ronald Reagan, for years, as we often do, as was done in Spain, if there is no money for the resolution authority, then it cannot really start its work. And then you have to ask Parliament. Parliament does not want to provide the money because the taxpayer will not be happy, nobody likes payments and all these kind of things. And then you get into trouble. Now, that is an example where a federal system didn't work either. Now, with the benefit of hindsight, FDIC did well. But FDIC is mostly resolving small banks, except for Washington Mutual. And so, in a sense, it was a bit a spectator for where the action was going, which was AIG for insurance and all the big investment banks. So in that sense, I think we should make sure that the banking union will make sure to resist the kind of political pressure that will just move the European Parliament and everywhere. And indeed today, I guess your story, Jorion, about the accounting board, this was all federal, and it was all pressure within the federal, the House of Representatives and the Senate. So I think indeed local pressure can be a problem and will be less of a problem now, but let's also think about European level pressure.
Thank you. Mr. Roelandt, reaction?
Yeah, well, a small comment a bit from practice. If you're looking now in discussion, is it better to have a regulator which is close to you or one who is very distant? If you look at, let's say, the creation of Solvency II, which is also a unified legislation, the complexity that it brings, because it has to take into account, let's say, 27 local situations that were created for decades and decades, hundreds of years ago. So that becomes very complex and very unadapted, let's say, to the local situation. That's one element. The second element is if you want to have in real practice, let's say, a regulation which is thought through on a European level, on a supranational level, then it also, in my, not experience, but in my thinking, it becomes very difficult for a local regulator. Let's say, well, Europe, they say this and that, but here in this country, we can do it with a bit more or a bit less. So it becomes unfeasible, let's say, to act as regulator against European legislation. And then the disadvantage of that is also that your regulator can move away from it to say, well, I cannot answer that question. I understand it from an economical point, but I cannot do anything against or for you because I'm bound by the book, by the European book. So taking this Spanish example, that there was a local pressure and there was politics, well, okay, that's I would say a Spanish problem. Try to say you could resolve that if the authority who would regulate that would be European. I think that's an easy way out and a big gamble. It's also a big gamble, I think, for smaller countries, because putting political pressure, and the United States example is very clear on that, I would think. If you still have a strong lobby, you can try to get your ideas through. If you are Germany, I think you have a better chance to get your ideas through in Europe than if you are Belgium or Luxembourg or Denmark or something like that. So is that the way that we want to operate in Belgium? We are all Europeans, but I have my doubts there.
Okay, thank you. Mr. Bellemans, I have a question for you. You say that if we compare with the industry, commercial service sector, in the banking industry there are some unique characteristics. Can you explain it?
Okay, true. Let's take an industrial company. If it wants to expand its production, it has to hire more people, it has to have more machines, maybe more factories, etc. It takes a long time. It takes maybe a year to have the factory. If a commercial company wants to expand, it needs more stores, more people, more inventory. If a service company, let's say a transportation company, wants to expand, it needs more trucks, more planes, more ships, more people, etc. The bank and the video have shown how fast a bank can make additional loans. It takes one person, it takes maybe a few hours to have more loans. I worked for a bank for 6 years. We specialized in the financing of trading of commodities. We had a credit committee every day. We were meeting every day to approve the transaction that our clients had asked for us to approve during the last 24 hours. Within the same day, we had approved most of the transactions. Most of these transactions start with a letter of credit. The letter of credit were issued the same day. In 24 hours, we could issue letters of credit for hundreds of millions of dollars, which means we didn't even need the financing because it's a letter of credit. A letter of credit is just a signature of a bank. We did not need financing. Often the transaction ended with the client getting money from their clients, from the company they sold to, like oil or grain or fertilizer. Our clients were getting money from their own clients before we had to pay the suppliers. So there was no financing needed. Huge amounts approved and executed in 24 hours without any limit. So this is unique. If I may give another example transaction, I worked on a number of loan syndication. A loan syndication is a loan made together by a number of banks. So one bank typically puts together the loan, negotiates the loan agreement and the condition of the loan, and the bank invites other banks to participate in the loan syndication to spread the risk. Well, I have, for example, one loan to Sudan, we have made my bank made a 20 million participation in a loan with almost no work. We just were invited by the lead bank, which was Chase Manhattan. are you willing to participate, $20 million? We said, yes. I went to Khartoum to sign the loan agreement, that's it. In a few minutes, or a few hours, the deal was done and we had $20 million of assets, which we had in the books for 5 years. So this is unique. No industry can expand its production or its activities as fast, as easily. And this is the problem then for the managers of the banks, because it's tempting. It's so easy. It's tempting to increase the outstandings to crazy levels.
Okay,
if you don't mind, I would like to talk about the effect of leverage. And I hope this is short. I'm going to give a very simple example. We do a short here.
Yeah, sure. There is.
Where? Okay. So, very simple example. Let's take two banks. Assets, liabilities plus equity. Let's suppose the bank here has 100 of assets, 95 of equity, of liabilities, and 5 of equity. And total, of course, 100. Both balance sheets have to balance. Let's take another bank with the same total balance sheet, then 100. However, liabilities are 90 and equity are 10. Okay? Let's suppose both banks have a return on equity of 1% of assets. A return on assets, excuse me. Return of assets of 1%. Okay? So both banks make a net income of 1. Okay? 1% of 100 is 1 per year. Look at the return on equity. The return on equity of this bank is 20%. The return on equity of this bank is 10%. So by leveraging the bank 10 times to 1 instead of, 20 times to 1 instead of 10 times to 1, you can double your return on equity. And I live this because I work for an American bank. We have the balance sheet like this. And French banks, this is in the 70s, 80s, 70s. French banks and Japanese banks typically have the balance sheet like this. So it's no longer
Yeah, I will go there. I'd like to make one remark. Monsieur Dewatripont mentioned the FDIC as the description he made. I had mentioned the FDIC during my talk, and I had mentioned about the bank I was working in, and that indeed FDIC steps in if there's a default on typically a small bank, small, not one of the top too big to fail banks in the US. What's interesting is for many years the FDIC until very recently was headed by Mrs. Sheila Blair. And she's recently written a book and about her experience, and I would say there are two main stories in her book. The first thing that she really wants to show is the following, is that when governments in the countries like Europe or the United States say the crisis has not cost anything to the taxpayer, she wants really to, how would I say, show this is the story which is being told to children, but that's not the case. And she comes up with the figures that show, particularly in the United States, why when the government says, well, actually taxpayers has not been out of his pocket or her pocket, that's not the real story. But the other thing she wants to make sure that people understand from her book is the following. She said during the whole crisis, the part where Mr. Obama was in charge and that Mr. Timothy Geithner was the Secretary of the Treasury, she said he's been acting deliberately to favor only one player in the industry, which is Citigroup. And when we hear that, that kind of reminds us of the story about Mr. Rubin, who had been working systematically and quite consistently in order to become a chairman, CEO of Citigroup after he had modified regulations in one particular way. So my question to the panelists is the following. If we hear that Mr. Gertner is not part of the new administration of Mr. Obama and that he's moving to Citigroup, what can we do about that story? Is there anything we can do, or is there anything we should say, or is there anything we can do to prevent that this one story happens again? Because that would be a déjà vu, it would be the second instance of the same story we've seen before.
Well, I cannot speak about the United States situation, but I'm not so sure whether we see those things here in Europe or in Belgium in particular. But the thing in my mind would be very simple. It should not be allowed. Simply, you should ban it. If you are a regulator for a number of years, you should have a cooling off period of, I don't know what, 2 years, 5 years or something, before you can step into the industry. That would prevent such type of things. And there are a number of things that you cannot solve with other means as banning it simply. It should be not allowed in my mind.
Reaction? Mr. Dewatripont?
No, I agree, obviously. I think, by the way, right now in Europe, the ECB, the cooling off period is one year. You may think it's indeed too short. But I do think obviously there are different things one can do to limit these risks of capture. I think the US, in that sense, is a very, very bad example. Because the importance of money in politics, because the supervisor is only working for the government. So if the regulation is bad, then things will not be good. And I think that's one advantage we have, frankly, in Europe. The influence of money in politics is much lower. By the way, in the US, it has been increased, this influence in the year 2010, I think, the famous Citizen United decision at the Supreme Court, which basically, which I think is pretty amazing, has decided 5 against 4, because these judges, 5 Republicans and 4 Democrats, to make it simple, they have decided that corporations have the right to free speech. And that basically you can, without limit, spend as much money as you want to basically influence elections. By the way, in the November election, it has backfired. I think all this money that has been spent has not been without much of an effect, because not only Obama won, even though I guess Wall Street was pro-Obama 4 years ago and anti-Obama this time, because he put forward the Dodd-Frank Act, which is regulating a number of things, and Wall Street didn't like it. Also, in the Senate, the Republicans didn't win, even though they had a lot more money. So money can backfire also in politics, but clearly, I think Europe in this respect is much better than in the US, and hopefully will stay this way.
If I can give a concrete illustration of what Mr. Dewatripont has said, Finance Watch is an NGO that was founded because almost 200 elected officials throughout Europe, from all political horizons, right, left, Greens, Liberals, you name it, signed a call saying we need to establish basically a counterweight to the financial lobby. 200 elected officials signed that call. And obviously, in a democracy, we are all lucky to live in democracy. When you have 200 elected officials saying, we want this to exist, it helps. I mean, it gives a big momentum. I was discussing not that long ago with a person who has a very similar responsibility to mine with an American association called Better Markets. They're doing a great job. Go to their website, Better Markets. Very similar mission. I mean, the objective is very much the same size of teams, budget, and everything. So, guess what? We get along very well. And the guy was telling me, you are so lucky, because we in the USA, we would never get one elected official signing a call saying that we need a better market. And the reason for that, and that's him speaking, and I'm sure he would say it, if he were here, is that being elected as a senator in the USA costs between $5 and $25 million just to run a campaign. Guess who pays? I mean, there's very few individuals who have that sort of money available to pay for a campaign. Being elected, I've had discussion with members of the European Parliament. As we know in Europe, members of the European Parliament have legislative power in terms of financial regulation. How much does it cost a campaign? Depending on the answer, it's 20, 30, perhaps 40,000 euros, which is not nothing, but it's a sum which is within reach of, it's much easier, so it's nothing comparable, and therefore it's not, whatever industry, and in particular financial industry, who pays for it, and therefore you have elected officials who are more free. I'm not saying everything's perfect in Europe, far from it, but I would completely agree with the assertion that in Europe we're lucky to still have a political class that has a notion of what public interest means, and that's true beyond political borders.
Okay. Monsieur Roelandt, I have a question for you. Yeah. You link the relationship between supervised bank and politicians also with bailouts and credit crunch. Can you explain it?
Well, I think right now, I think what is interesting about what the political world wants about banks is at the same time no more bailouts. Taxpayer money should not be used to bail out banks. And therefore, we should do a lot of things to prevent risk-taking by banks. Possibly, in particular, split their activities, ask for more capital, or a number of things to make sure that they will not cost money directly to the taxpayer. But on the one hand, and on the other hand, there is also this view that we want banks to lend more to the real economy, and particularly to these poor small and medium enterprises that everybody loves because they are so fantastic, and basically that they should therefore be less conservative and so on and so forth. And I do think that, okay, on the one hand, I think it's consistent because I think they are trying to say, and they are right, that we want banks to do fewer casino-type operations, speculation, blah, 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 but do better the role for which we like banks, and I think people have understood, and that's good, that banks at the same time can be very dangerous animals, and on the other time, they are really needed. A world without banks is not good because people need to be able to borrow in order to basically finance the real economy. But at some level, let's face it, if we relax lending standards too much, we will also get into trouble. And by the way, this, while exposed, it's very easy and not wrong to caricature this subprime lending. Let's remember that the idea in the beginning by some people, some somewhat naive people, that was a generous idea, which was this idea that poor people should also be allowed to buy houses and become owners of houses. And then, of course, it derailed, but it can easily derail these kinds of ideas. So I think the idea is that it's complicated, and since it's so complicated, then you easily open the door to bank lobbies to say, aha, if you want us to help the real economy, you should avoid all these kinds of regulation. And that is the line they are pushing very strongly. And then people start, they don't know where they stand. And even if politicians are not, like in the US, cynically trying to track money from lobbies, they can still be a bit lost at times. And this is what makes the debate pretty dangerous also. Because it's complicated. So, but hopefully supervisors and politicians together can try and channel things in the right direction and make sure that indeed we use the bankers for what they are good at for society.
Thank you. We talked about some cases in the United States, but Mr. Roelandt, there's also a case close to home. For example, the Antwerp insurance company Leven.
Yeah, so without going into detail into Leven, let's say also there is a number of things that apparently, according to the public information, were going wrong. There was also elements, let's say foreign ownership, let's say funds used, let's say the same country as the home country of the owners and stuff like that. So if you took more a helicopter view on that case, this is a case where it becomes very difficult, I would think, for a regulator to see through the entire case. So the life of regulator is not always easy, and the question that puzzled me was how could you avoid that? And in the debate of would it be better to have a global regulator to look into those things? This is clearly, in my mind, clearly the case that the further you're away from the real subject, the more difficult it becomes, let's say, to regulate that and to see through the transactions that are on the books. If you have a building block, which is situated in Antwerp on the Keizerlijn, for instance, or here in Brussels, adjacent, you as a regulator, you can see it and you can have an impression. If I have the same building in Beirut, with the same value in my books, the same rules applied by Beirut. Maybe it's too harsh of a situation. Stick to a case in Europe, building block in Athens, for instance. What is the value of that, and how should a regulator be able to value that? So this is an anti-European statement. I'm very much aware of that. But if you want from your regulator to be effective, you should also give him the arms, the weaponry, let's say, to fulfill his job. And then I'm aware I'm coming back to kind of national interests or national regulation. It's much more easy, let's say, to regulate that in a more when the distance is not that big. As you mentioned in the introduction, I'm coming from the Belfius group, and I spent a number of years of my career also in the Dexia group. So Dexia was an entity which was active in, I think, 38 countries all over the world. For a regulator to look through all that, that's an immense task. It's impossible to do from a global point. Again, I take the example of the failure of that small life insurance industry as a plea for a regulation which is closer to home. So I'm not on that European global thing. That's very clear.
Mr. Dewatripont, do you agree?
Well, maybe I will switch back closer to my table here, because I do think, let's take the case of Dexia. I think, I can see the advantage, and I think it's important to have local knowledge. I'm with you on that one. But let's face it, as you said, Dexia was active in 30 countries. Now you have home country control, so the lead supervisor was Belgium. Did Belgium have good information on what was happening in all three countries?
No.
So
another question is it possible? Is it possible for a local regulator to have that knowledge?
Well, definitely it was not possible for the Belgian one, with its knowledge in Belgium, to have information in every country. So we had to delegate the supervision to the host countries. and but it did not have full authority on the host country supervisors. And that I think is a good, I think Dexia is a good example for why we need a banking union. Because in a sense, but what will be needed, and of course that will be a challenge, we need good coordination between the various national supervisors, and I think you will need enough lines of authorities from Frankfurt to the various national supervisors. So in a sense, you almost need a merger between all these. So at least for the big banks. For the small banks, I guess one can discuss a lot more about whether the delegation could be much stronger, so that purely Belgian entities would really be supervised at the Belgian level. But I think what was lacking, and there, if on top of that you have the political pressure at the local level, but I think there was this other problem, which was coordination between the homes and the hosts. And I think hopefully a well-designed banking union will solve that and bring us closer then to a US-style system, whereby the federal level can have more authority on the systemic, the national banks. Perhaps you know.
Thank you. Mr. Jorion.
Yes, once again, I would like to ask a question to the panel, which is the following. We were, let's say, like in the 1950s, if we think of Europe, there was a way of running a state, a nation, and there was a particular way of running a business or a corporation. And we know that from the 1970s, the influence of Reagan in the United States, or Mrs. Thatcher in England, to some extent the ordo-liberalist, liberal tradition in Germany in the period after the war, there became more and more the idea that you should run a state like a business that became pervasive. And some Nobel Prizes like Gary Becker, who said, developed this view of human capital and so on, went to going more and more in that direction that the state should be run more like a business than it was the case before. My question is that change the role of the regulator, the fact that we go more and more, and I think it's the case, it's probably less the case in Europe than in the United States, but it is the case in Europe too. Let's just think of the way that we are dealing with the countries which are in difficulty right now in the Eurozone. Has the role of the regulator changed by the fact that the state is more and more run itself like a business?
That's a very difficult one. I would think it certainly has changed, but is it due to that? I think that the regulator should also be, let's say, the stable element in supervising the business, since, let's say, political systems or political, let's say, coalitions change that much, and mostly let's say, long-term vision, according to some, to put it diplomatically. That's more an influential thing, where the regulator is more, let's say, a safeguarder. So he's there for the longer term, while governments who should vote the laws, let's say, which are the basis of all that regulations, change for that long-term perspective too quickly.
Okay. I would say, don't pretend I have all the answers to this difficult question. I would say I would see the issue less, maybe disagree with that, or that the state is run like a business or supervisors run like a business, and much more as there's some implicit assumptions behind many things that are done that are far from being neutral, that are effectively political, I could almost say philosophical choices, and that are presented or shown as perfectly neutral or not even discussed. So I don't think it's so much, run as a business, but it's, we're doing it because it's the only way to do it. It's the scientific way of doing it, and therefore, we have no other choice. When sometimes it's far from being obvious. I'll give you an example. It's a very concrete, almost anecdotal example, but which I think illustrates this. I was recently in a stakeholder seminar organized by give a name, the European Commission on long-term investing, and the question I was asked to address was, okay, the debate is how do you channel capital to long-term investment? Very important question. Investment, not betting, investment and long-term. Very good question. And the question I was asked was, is there a danger to give up the current neutrality of financial regulation to have a regulation that will be in favor of long-term investment? Is it dangerous to give up the current neutrality? And my immediate reaction was, well, current regulation is anything but neutral. It is not neutral. Everything is short-term oriented. But what was really interesting in that question was not the debate that started there. Is that I think that the people who asked the question were honest. They believed that current regulation was neutral. So there's an implicit, that's really the capture. There's an intellectual capture saying, oh, today we're neutral. No, we're not neutral. Nothing is neutral. By the way, by definition, the regulation is not neutral. If it's neutral, why do we have a regulation? So, and I think that's the main problem. And obviously, all the Eurozone issues and I'm sure behind your questions there's all the questions about the currency and do we have a complete currency in the Eurozone? The answer being no, we don't. And all the austerity policies behind. There's different ways of looking at things, but very often they're presented as the only possible way. And what frightens me sometimes is that sometimes we have the cynics, but sometimes we have very, as I said, very honest people who honestly think that it's the only way to do it. When and this is where the debate and academics and universities is so important to feed the debate.
Well, coming to your question, to me, I associate Ronald Reagan and Margaret Thatcher to the idea that we should have a smaller state and a state that produces less. And indeed, they have, in particular, Margaret Thatcher has privatized many industries, starting with things that don't necessarily are not necessarily considered as public goods, like steam and cars and all these kind of things. And then she went on privatizing also natural monopolies, electricity, gas, and so on. And I think she has had a lot of influence because afterwards many countries started doing the same thing. I remember that in France, Lionel Jospin was very active selling industry stakes, particularly because I think social democrats had decided that between the welfare state and public production, they decided to go for the welfare state because they understood better what it would bring. Now, I think in a world where the private sector is more important in the production of goods and services, and by the way, China and Russia don't go the same way, but let's say in Western Europe, then Eastern Europe, and in North America, it's really private. I think that the role of the regulator or the supervisor is more important than ever. Because, and I guess for those for whom it was not clear, I guess the financial crisis has shown it, market economy doesn't work properly if it doesn't have proper rules. And you need to enforce these rules, and in particular in sectors that are so complicated like the financial sector. And so I do think that, in a sense, and I guess right now in the UK you have a conservative government, but they are the ones that are implementing the Vickers reform. And they are reasonably, it depends, we can discuss on some dimension, but clearly they are definitely not, they have changed their mind with respect to a soft or light touch regulation, which they were really proposing before to have the City of London and all that. So I do think that indeed, in this kind of world, strong regulation is really important.
Mr. Bellemans, I have a question for you. Some banks are fearing new regulations because they say it's very difficult and expensive to implement. What do you think about it?
They are wrong. In my opinion, they are wrong. They should not complain about regulators. They should first do their homework, do things properly, and regulators are needed. Otherwise, we are going to have again the same crisis. If I may just mention one thing, this is the tip of the iceberg. The balance sheet is the tip of the iceberg in a bank. You have all the contingent liabilities, all the off-balance sheet items, letters of credit, guarantees, swaps, forward contracts, options, futures. Some banks have total contingent liabilities larger than the balance sheet itself. So you look at the balance sheet, you say, oh, it's $1 billion or whatever, or 1 billion euros of risks. No, because you have another 1 or 2 billion euros or dollars of risks that are below the line. This is often forgotten. It's very, very difficult to analyze. When you look at the balance sheet of a bank, at an annual report of a bank, you look at the disclosure, contingent liabilities, it's almost unreadable. How can you understand the risk involved in these letters of credit, these guarantees, the derivatives? So regulation have to be stricter and strict, because banks then find ways of going around regulation. Basel I did not, if I'm not mistaken, Basel I did not address the contingent liabilities. So the bank substituted instead of loans, well, they got rid of loans, so it disappeared from balance sheet, but they guaranteed the loan, so it appeared in the contingent liability. So it's a way to go around Basel I, etc. So this is terrible.
Mr. Roelandt?
Well, I had another example of, let's say, the other way around, and it has to do with Solvency II, where we try to measure, let's say, all the risks in our balance sheets, in our insurance balance sheets, and one of the elements that we try to measure is market or interest rate risk with respect to sovereigns. Yeah, and in Solvency II, although a few states are in trouble and one state, European state, is in very big trouble, all those calculations are still at the level of 0. So sovereign risk is 0 risk, whether it's Belgium, whether it's Holland, whether it's France, Germany, Greece, Spain, or Portugal. Yeah, and that's also political pressure. Yeah, so it's very. I mean, in my reading of the subject, it's very difficult for Europe to say that one country, if you buy one country, it should be measured in a totally different way. Yeah. So you have pressures of all kinds. Maybe you can avoid some on the local level, but then you will have them on another level. Difficult one.
Yeah, question.
If I may try to react to the out of balance sheet items, I feel there is a classical confusion between the volumes and the risk. You have effectively an enormous volume of interest rate swaps, for example, in the out of balance sheet. You can only see for some banks producing the information what is the market value of those swaps. And then you have a first idea of the risk. And you might have a trillion volume business if it is fully matched with good counterparty, with quasi no risk. You can have interest rate currency swap for a limited amount in, I would say, banana currency that could create enormous risk for the bank if you go into a very stressed situation. And we need to be very careful when we look at the figures and the numbers, you know. But I have a question for the panelists. We've all been laughing about the story and what I would call the fuck you story that we see in the beginning. Do you feel that if we had a chance to look at that story 10 years ago, we would have been laughing too. But would such a picture have been able to prevent us to go into the crisis and into the structured products and into all those, I would say, silly things that we have discovered later on?
Unfortunately, I'm convinced the answer is no, because it's always the same story. You know, it would have been like, oh, you don't realize, you may be funny, but you know, the real world's like that. I mean, we all know that this cartoon is just 100% correct. It is exactly what happened. But if you say, this is the way it's happening today, and by the way, it is the way it's happening today again, you know, it's not exactly the same story, but you have things that are very similar that are being done.
Then we come to the question of the regulation. If we know it's true, do we feel, are we certain, I prefer certain, that the new regulation that we put on table and we would like to put in force are real protection against the renewal of such things?
My view on that is a number of very important measures have been taken. They are going in a, I mean, always difficult to generalize. You would have to spend 3 hours, you know, regulation. But globally, many of them are going in a direction that makes sense. But my view is that we've made, you know, 5% of what needs to be done to make the whole system really, well, two things: resilient and serving the economy, which at the end of the day, it's the two objectives. So now, is it 5% or 10%? I don't know. But you know, we're shifting the glasses on the table when the table should be turned upside down. So you know, yes, we've changed, you know, the place of the glasses, but there's much more to be done, and that is to do about, you know, the way we conceive finance. You know, what's finance for? Investing, not betting.
Yeah, well, it's a bit the same thing. If you are an insurance company or a bank, and I take the example of the insurance company because I know it better, is it your role to speculate against something, against the good, against the currency, against, let's say, a state? In my opinion, it's not your role. Are you allowed to have, let's say, derivatives in your balance sheet if it's to a real economic purpose, if it's really covering something, a real risk in your balance sheet? Why not? Why not? But it should stop there. If you are allowed to do much more, then the actual answer, if I understand the new regulation well, you are allowed to do that, but you have to put in more capital. The answer is capital. To my belief, that's the wrong answer. You should not be allowed to do that. You should limit to your role. Yeah? And it's always in let's say, those extras and in changes in the environment that those extras becomes a very dangerous thing. It's also about leverage, all the elements that you can mention. If you only use it, let's say, within in an economical way, it's maybe very difficult to define that. What's an economical way? Then that could make sense, and the risks are rather limited. But in many cases, you see that the same instruments are used because they can create what's called value, and they're not. In my opinion, they are not creating value. They are creating sometimes money, and they are often creating a lot of risk. And they are not creating value. You should not allow. The example was given of the Canadian banks. Why didn't Canadian banks not go the same route as the US banks? Simply because their regulation was different. Their regulator or their government said, no, you are not allowed to invest in this and that, and so on and so forth. It was more strict. Result at the end of the day, Canadian banks, all the big Canadian banks, didn't have to be saved. A lot of US banks, something else.
Mr. Jorion, yes, about your question, whether it would have been possible to write a little video beforehand. Well, as one of the people who had written a book explaining this beforehand in 2004 and 2005, of course I have to say yes. But at the same time, I was asked
recently how many people had actually predicted the crisis. And you know some of the names, Jorion, Godly, there's maybe one or two other people. If we had got together, let's say the 6 of us in a room, we could have written that thing in 2004 because we knew it. But at the same time, it wasn't a climate where it was only possible to get like a handful of people to do so. Why? Just 2 examples. In 2003 or 4, there's a paper written by Mr. Gunaya, who's one of the best people in the team of Alan, I forget his name, at the head of the Federal Reserve, I'm sorry about that. Alan Greenspan, one of the best people in the team of Alan Greenspan at the Federal Reserve, writes a paper saying that financial bubbles do not exist. They can only be assessed after the fact. You can say there was a bubble, but there's no way to see there was a bubble at the time that it was developing. So, and he's in a good position. He's one of the best people around Alan Greenspan. He's heard, and his argument is being, and his article is quite interesting. It's not stupid. It is well developed. At the same time, Greenspan, who does believe that there's a bubble, has a totally objective and explanation of what is going on. He develops the argument, which was probably proposed to him by somebody also in his team, that has been a major impact on the prices of everything due to the development of the computers, especially microcomputers, that there's one industry which cannot be as impacted as the others by the development of a computer, which is the building industry, and therefore the price of housing, of new housing in particular, to which existing housing will get aligned, will go up relatively to all the rest, and that is a perfectly objective and, how would I say, there is a fundamental reason why the price of housing will go up in an environment like that, and that it doesn't show that there's a bubble. So at the same time, as a few people who believed in bubbles were seeing that one day, and that doesn't show so much in the story, of course. I mean, it's funny, it's supposed to be in two minutes. It doesn't show the, how would I say, the subtleties of the bubble. If the bubble could have been sustained by bringing more and more people in buying housing, which was an idea that Greenspan had at some point when he said we should get some of these Indian people working on software for the American companies, we should then bring here. We should bring all these Indian people working as being on the phone, responding to inquiries for American businesses, which they were. We should bring them in, and we could then make that bubble not be a Ponzi scheme just by bringing more people on and on. So it was possible to make that little movie, but the fact is, and that's been said by the people here, nobody would have looked at it, or the people who would look at it would have said it's nonsense. It is nonsense. Like I had the response with my manuscript in 2005, it is nonsense. When it got published in January 2007, and we were just 1 month away from the whole crisis developing, people said, well, it's not nonsense. But in that period before, as you know, I mean, in these speeches by Greenspan, we are at cruising altitude now, we put the automatic pilot. You can find these statements from Greenspan. Now people at head of central banks know exactly their business. Nothing will happen again at the level of central banking. It's funny right now when we think about the situation we are in, but that was the doxa. That was the accepted opinion by nearly everybody.
Mr. Dewatripont?
Yeah, I think on the question of how much is being done, let me take issue with the idea that only 5 or 10% it has been done. First of all, I think that the first element of the crisis, the subprime lending, which was the first part about lending to people who clearly will not be able to pay the interest after a while when the interest gets tripled or these kind of things. these so-called teaser rates, for which at the beginning you pay almost nothing, and there was a chain of incentive problems with these people who get paid commissions in order to have these loans, and then putting the loans to somebody else, and then to somebody else, and so on and so forth. And the only reason why this thing could make sense for an unscrupulous lender being the fact that if indeed 3 years later the person could not repay, then you could seize the house, and then you could make a profit because the market would have gone up, and so they were betting on the market going up, and then the thing stopped when the market stopped going up. I think stopping this is not really rocket science, it's just consumer protection. And by the way, the subprime problem appeared almost only in the US now. So it did not take place in Canada, it did not take place in most of Europe. The problem is that we got contaminated because they were able to package the stuff, make it very complicated. So it was basically a financial innovation, and people got impressed, especially because the rating agencies were brought in to collude and to pretend it was AAA and so on. Now, by the way, the rating agencies they misbehave big time on this, but not on the rest. I think on simple products, their rating did not inflate the way they inflated on these kind of things. So I do think, by the way, all this subprime stuff, all these complex products, they kind of almost disappeared. New production almost disappeared instantaneously. So the markets corrected it. And of course, those who had bought it had to live with it and still live with it. It's a legacy problem, but it's not, I think that part of the thing, is basically settled. And I do think the rating agencies have learned their lesson somehow. They need to be regulated more strongly, but somehow I think they are helpful. I think the US is going too far in saying we don't want to have ratings in the regulation anymore. I think that is excessive, but anyway. What is, I think, with us, and will come back with new financial innovation, these kind of things, is indeed that people can become over-optimistic, naive, and people then take advantage of it. And so bubbles and all these kind of things are always there. There is this very good book by Carmen Reinhardt and Ken Rogoff called This Time is Different, 8 Centuries of Financial Folly, showing that all these bubbles and crises, I mean, there are many over the centuries in many countries and so on, and I guess they will come back. And it's difficult to prevent them because it's difficult to understand quickly enough what is the new thing that will come. So I do think one thing which is definitely not there yet is that we need much stronger automatic stabilizers in the banking sectors, the so-called macroprudential regulation. There I think a lot more is still to be done to basically make sure that the instability in the macroeconomy does not create strong procyclical effects on the banking sector and big banking crisis or insurance crisis that could also come with the current environment. And so we need to have these buffers basically asking much more from the industry to pay up in good times, possibly pay more tax in good time so that they can get it back in bad times, just like we have that with the public budget. So taxes go up in booms and they go down in recessions automatically. That's Keynesian stabilization policy, and that helps a lot. And I think we need a lot more of that to stabilize the banking sector, because I think banking supervision works reasonably well when we don't have a macro crisis. The big problems come when you have a macro crisis and you don't have the money, and the government doesn't want to give you the money, so you wait and you think that it will get better. Gambling for resurrection that supervisors can also do, and then the problems explode. But I think that is still very much ahead of us.
I hear you work for Fitch, for the rating agencies. Fitch, do you want to react?
Well, I can contribute to this discussion if you invite me. From the rating side. Yes, I work for Fitch Ratings. I'm a senior director there, but I started at Moody's. So over 10 years, I worked between 2 rating agencies. And that is a very interesting point, effect of regulation on the way rating agencies conduct their business. Believe it or not, we have more business than ever now, when rating agencies are kind of regulate or better regulate. Why? Because regulation provides a license and investors become more complacent with the rating, which should not be the case. There is proper way to use the rating. It's only at a minimum level for you, if you're an investor. So that guy in the Norwegian village, you can think of him as an enabler of the whole securitization chain. There was demand for the assets. Who asked German banks to buy subprime mortgages? Probably there was a reason to buy subprime securitization branches based on subprime mortgages, based on certain factors. So the judgment of the investor is not taken into account. My suggestion is to focus more on investor who enable the chain without allocating the blame on the bad guys.
How can you make sure that an investor is really capable to understand what is really in a structured product?
Wonderful point. Why do you think investors are stupid?
I don't think investors are stupid. They are just not provided the right information and the time needed to understand the information before making the decision to invest.
Brilliant point.
Can I?
Okay, shortly.
Yeah, I'm an academic at the University of Westminster, and I wrote a big book on EU and US disclosure regulations and securitization law, published in 2009. And during my research, I was quite surprised at what was happening in the subprime, quote, asset-backed securities market. I had lots of conversations with investors around the planet, and I was very surprised at how little they understood what they were doing. Although they were technically equipped to be even posed to look at these documents and to look at the disclosure, they didn't do it. So the truth is, I mean, from my academic research, I talked to a lot of investors, lots. And they did it because they thought it was a good fashion. There's a lot of big banks that didn't have that much trouble selling these products to so-called sophisticated investors, because the sophisticated investors would have really fantastic websites purporting to say that they were the best in the world to investigate, scrutinize, and look at these disclosures. Totally laughable. So I think the blame game that goes around, that you have to remember at market, there's a buyer to these instruments. And those buyers are still in existence if they were lucky. So anyway, I just wanted to say that there's lots of people working on, say, Dodd-Frank right now. I would agree with the gentleman that 5%, I think, is actually quite optimistic in terms of how much is actually focused in on the real problems. But I also agree with Victoria that you're looking at the wrong place when you want to cure market problems. You have to look at the investors and their actions. Because those guys are not just guardians of your money. They have a fiduciary responsibility to do their job properly. And for a lot of those people who disappeared, they really didn't do their job at all. I mean, that's what I think.
Yeah,
Okay,
the rating
thank you.
agencies now are doing better than ever because they are entrenched in the regulation. We got full employment act.
Yeah, thank you. Mr. Jorion.
I would respond to you with a little problem, which is the following. I was working at Countrywide, so we were issuing these mortgage-backed securities, these subprime asset-backed securities. Okay, there was a part we were not selling, which we call the residuals, and you may know what it is. It's really the bottom of the reserves you create for your security. We were sophisticated in terms that we knew what we were doing, and we were selling the product, and so on. And we were looking into the details of the individual loans. The residuals, that came so automatically that we were making 4% being untouched for the future. Sometimes people were so interested in that these residuals, potential clients, that we were selling the residuals to somebody.
Some people in Connecticut, I know, do a lot of that. Oh, anyway.
Yeah. My point is that at that time of knowledge of what's going on, nobody was sufficiently sophisticated really to know what was actually going on, because nobody had really integrated the whole dynamics of the bubble. It would make it one day, like snap, suddenly the residuals would not be there, but they would be zero. There would be nothing in it. And that happened on a very short period, over 1 or 2 months.
I agree with you. And in fact, over the period, if you look at the long history of securitization, in 1998, the bubble really was bursting, and the first, the top 10 securitization vehicle-stroke entities actually disappeared in 1999. So the 1998 bubble, which doesn't have very much history, we don't know very much about it now, but if you just look, you had already the occasion of history. When I was in New York in 2005, 2006, I was talking to a lot of hedge funds as well as part of my research. They scared me to death. The type of information I was getting at lunch over 45 minutes caused me in 2006 to go personal on the information. Professor, I mean, you were inside the bank, I was outside looking in, but I used to be an investment banker back in the 80s for my sins, so I used to run billion-dollar books, and this just scared me. So I went personal, I liquidated everything I had in 2006, and went cash, finished the book, and what I saw, just a little bit more information about this controversy, I saw reports in the FT and other mediagenic concerns reporting quite wrongly what was going on. In terms of, for example, the valuation. The information that you have with regards to residuals is very well known amongst professionals, but not well known amongst the media. The other thing is that we had indexes that were created that did not at all statistically show what was going on in the market. And those were taken up by quite big people in the media as actual information about what was going on in the market. So there's this other thing that I think in the loop, media, and how it promotes certain types of, quote, information, but not actually understanding what information they have before them. Is quite dangerous to our society, which is very hooked up. The gentleman's diagram with regards to balance sheets and risk, I mean, this is back to 5000 BC. This is how we do things. It's how we create money. This is how we trade. So, and then this notion of how we clear derivatives. We have $69 trillion in shadow banking derivatives at the moment. 70 trillion is the GDP of the planet Earth. Do you think we have a chance once things start to get bad to clear any of that? I don't think so. So I think what we need to do is focus on, number one, is the investors, what they're really doing. Second is that if we're going to write regulations, my goodness, Dodd-Frank with 2,300 pages and not one line on Fannie Mae and Freddie Mac, that's madness. So anyone who knows what's going on knows that the regulations were written for a period of time to kind of quell the market. I'm just hoping that here in Europe, people will kind of say, well, maybe we'll have a different way. Maybe we'll look at these investors. Maybe we'll look at how we do world trade and finance and continue. Not in the United States at the moment.
Okay, thank you. It's close to 6 p.m., so we have just time for one question or one remark.
Yes, in connection with this, what does the panel think of the proposals made recently by the FSB, the Board on the Financial Stability Board, on regulation of shadow banking, hedge funds, money market funds, SIVs, SPVs, and so on. And if that is ever implemented, will it change the role of the Belgian regulator?
I think it's a question for you. Yeah. You? Okay. Oh, yeah. Sorry.
Well, I think I guess to take a big picture, I guess the FSB suggests looking at shadow banking from 2 points of view, trying to regulate its activities or sub-segments directly, and then trying to regulate the links between the regulated banking sector and shadow banking. right now, things are evolving slowly. I do think that some of the regulation being introduced have an impact on transfers taking place between the regulated banking sector and the shadow banking. Different countries have clearly different sizes of shadow banking. I guess some of the, if you think of things like Vickers, it's in a sense saying, well, let's focus attention on a reasonably narrow definition of the banking sector we want to really make sure to preserve, and try and be less concerned about some of the things that are happening outside. I must say, I do think we haven't yet decided on whether we want stronger regulation on a narrower definition of what banking is, versus trying to encompass everything and regulating everything. Frankly, we probably want to pursue both approaches, being stricter and improving the resilience of a narrow definition, while at the same time trying to cast the net bigger. Now, what impact there will be on regulation? I guess in both cases that I mean stricter regulation, but on the balance between the two approaches, I don't have clear views, and I don't think people in general have clear views about this. But maybe some people on the panel may disagree.
Short direction, or otherwise? Okay, I think it's clear. So I want to thank you for the interesting debate.
Yes, thank you. I would like to thank from my heart the panelists for the wisdom they have given to us. I learned one thing, and it was the very start of the discussion. It was the distinction made between a regulator and a supervisor. Indeed, we have discussed lots of things about regulators, assuming that they are making rules. But rules somewhere, that we have heard yesterday, rules are needed if we don't act on issues conformity with well understood stewardship. And therefore we need rules. And precisely the supervisors are those who then, when there exist rules, are looking behind the rules and are looking at the way the rules are interpreted, which is much more difficult. And then there comes up an idea with me, being this one. Do supervisors and even do regulators really want to know what is going on at this moment? Or do they believe that the economy has to go its own way, even if there are some moments of pitfalls? And if they do, there is a second question. And the question is, when supervisors and regulators see that things, understand, feel that things are maybe not completely right, do they act at the right moment? No. Now, these questions are questions which we will continue, I think, to discuss in lengthy time